In a landmark 1995 paper, Shlomo Benartzi and Richard Thaler showed that investors who watched their portfolios more often took less risk and ended up with lower long-term returns. The math is brutal. Daily checking quietly costs ordinary investors thousands every decade. Today, I'll show you exactly why and 5 specific habits to break it. By the end of this video, you will know the 5 specific habits that break the daily checking loop, including the behavioral science from a 1995 Benartzi and Thaler paper that proves checking less builds more wealth in under 9 minutes. You check your investment app every day, maybe many times a day. It feels responsible, like you're watching over your money. But that watching is the problem. The 1995 Benartzi and Thaler paper, Myopic Loss Aversion and the Equity Premium Puzzle, published in the Quarterly Journal of Economics, documented this directly. Investors who saw their portfolios more often took less risk than was optimal for their time horizon and earned lower long-term returns as a result. That's a paradox. Checking more makes you worse at investing. Why does checking less work better? It comes down to one well-documented feature of the human brain: loss aversion. The 1979 Kahneman and Tversky prospect theory paper showed that losing $100 feels about twice as bad as gaining $100 feels good. So when you check your portfolio daily, you see many small drops. Each one stings. Your brain says do something. So you sell at the wrong time, buy back at the wrong time, miss the long-run upward drift. Long-run market data on globally diversified indexes like the MSCI World shows the same consistent pattern. Markets fall roughly 46% of individual days, but rise across about 73% of calendar years. Days are random. Years are not. Daily checking samples the random noise. Quarterly checking samples the signal. The first habit: pick a checking schedule. Then never check between those dates. For long-term investments, quarterly is plenty. Annually is even better. The 1995 Benartzi and Thaler paper showed that investors evaluating portfolios annually rather than monthly took on more optimal risk levels and earned higher long-run returns. The mechanism: less frequent evaluation reduces the number of loss aversion triggers, which reduces panic decisions. Pick 4 dates a year. The first day of each season works well. Between those dates, the app stays closed. The numbers will still be there when you look. Better numbers, usually. This sounds extreme. It's not. Your phone is the temptation. Move your investment app to a desktop or a tablet you don't carry. The 2004 Thaler and Benartzi Save More Tomorrow paper documented one finding clearly: automation and friction reduction increase savings behavior. The inverse is also true. Reducing friction to check increases panic trading. If deleting feels too far, at least turn off all notifications. No price alerts. No movement alerts. No, your portfolio is up pings. Each notification is your brain being asked to react. The less reacting, the better the outcome. Quick reminder of why this matters. By the end of this video, you'll have the exact 5-habit system, including habit 5, which is the foundation everything else sits on. 2 habits to go. Habits are easier to swap than to delete. Each time you feel the urge to check, do something else for 2 minutes. Read 1 page of a book. Drink water. Take a walk. The urge usually passes. The 1979 Kahneman and Tversky framework explains why swap beats willpower. Willpower is a limited resource that depletes through the day, but a pre-committed substitute behavior bypasses the willpower system entirely. Within a month, you'll notice you stopped reaching for the app. The peace of mind alone is worth it. The better returns are a bonus. The next shift is mental. Your plan is invest X amount every month for 30 years. The price today is noise. JP Morgan's annual guide to retirement runs the same analysis every year. Missing just the 10 best market days in a 20-year period cuts your returns by more than half, because the best days cluster right after the worst days. Investors who stayed invested through the 2008 and 2020 drawdowns ended up far ahead of investors who sold during the panic and bought back later. The plan doesn't change because today is red. The plan doesn't change because today is green. The plan only changes if your life changes. New job, new family, new home, retirement. Daily prices aren't life changes. They're weather. This is the foundation. Compound interest needs decades to do its real work. Long-run global equity data across MSCI World and S&P Dow Jones indices shows that diversified portfolios held for 30 years have produced positive real returns in the vast majority of historical 30-year windows. The math is on your side. Checking daily doesn't speed up compounding. It can only slow it down by causing you to sell early. The 1995 Benartzi and Thaler paper's central finding: myopic loss aversion shortens evaluation windows in a way that mathematically guarantees worse outcomes, only stops biting you when you trust the long horizon. Warren Buffett famously said his favorite holding period is forever. Adopt that mindset, then check quarterly. This is the kind of content I make every week. Clear, calm, no get-rich-quick. If that's how you want to learn money, you already know what to do. Two friends, both by the same low-cost global index fund on January 1st. Both invest $20,000. Both plan to hold for 20 years. Friend A checks the app every day. In year one, markets drop 15% mid-year. Friend A panics, sells half the position to protect capital, rebuys 3 months later at higher prices. This pattern repeats during the next downturn. And the next. Friend B checks once a quarter. Doesn't see most of the daily noise. Never sells. 20 years later, in a typical historical window, Friend A ends with about $42,000. Friend B ends with about $61,000. Here is that arithmetic, so you can check it rather than take my word for it. Friend B compounds at just under 6% a year after costs. $20,000 growing at that rate for 20 years is about $61,000. Friend A holds the same fund, so the fund itself earns the same return. What differs is that each panic sale locks in a loss, and each late rebuy misses part of the recovery. Morningstar's annual Mind the Gap study measures exactly this: what a fund returns against what its investors actually earn. It has run at roughly 1 to 2 percentage points a year. Take 2 points off Friend B's rate, and you land just under 4%. That same $20,000 over those same 20 years is about $42,000. $19,000 difference. Same investment. Same 20 years. The only difference was how often they looked. 5 habits to stop checking your portfolio too often. 1. Set a checking schedule, quarterly at most. 2. Delete the investment app from your phone. 3. Replace checking with a 2-minute habit swap. 4. Focus on your plan, not today's price. 5. Trust the long-term math. Long horizons reward patience. Next video is the 50/30/20 rule, the simple way to split any paycheck. It's linked on your screen right now.